Starting something is exciting. There are so many new things, different things to appreciate and consider, and the learning curve is rewarding enough that you feel like you're progressing nicely. Then, hitting your end goal or target is exciting. There's a rush of satisfaction, a sense of completion, and a chance to look back at how far you've come. You see the effort paying off, the small wins adding up, and the pieces falling into place. It feels earned. But everything in between, that's the boring middle. And that's where most investors fail, not because they picked the wrong stock or fund, but more often than not simply because they got bored, distracted, or sometimes scared before the real growth had time to happen. They end up wanting to fiddle around with their investments, tinkering about, and end up performing worse than if they didn't do anything at all. Investing is about staying consistent in the boring middle, and that's where the wealth is built. In this video, I'll explain how I personally handle the boring middle, which simple global fund I chose for it, and how it all fits together with my strategy. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that will be discussed is intended for information and educational purposes only and should not be considered investment advice or investment recommendations. Whenever you invest, your capital is at risk. In order to organise my investment portfolio strategy, I created the Metronome Portfolio. Now it's a fairly complex concept, and I made another video on this portfolio setup that's worth watching for a full explanation here. But in a short summary, the Metronome Portfolio is a layered investment strategy designed to support financial freedom by aligning with your lifestyle and risk tolerance. It rejects the one-size-fits-all advice in favour of a flexible, personal approach. It's built on 4 key layers or parts, the 4 legs: income, knowledge, emergency fund, and emotional balance, your financial foundation. The base: dividend-paying assets to cover your minimum viable lifestyle. The middle: accumulating ETFs for long-term growth and retirement. And then the tip, a small speculative slice for high-risk, high-reward bets. Together, these layers create a steady, resilient portfolio that grows with you and supports real-world financial independence. If any of that sounds completely incomprehensible, then it's definitely worth watching that video I mentioned earlier to fully understand what I'm talking about. But for this video, I'll be focusing on only the middle of the metronome, the globally diversified accumulating ETF for long-term growth and easing into retirement. The middle of the Metronome Portfolio works in the background. It's a place for your capital to grow passively and automatically once your dividend base, covering your minimum viable lifestyle, is established. This layer is built around a chosen accumulating ETF, broad, globally diversified funds that automatically reinvest any dividends. That means there's no need for tracking payout dates, no need for decisions about reinvestment, and no need for monitoring company news. You simply buy, hold, and forget. It's designed for moments in life when you're earning well and want to invest surplus cash without the stress. You've maxed out your base or tax-advantaged accounts. You want to build wealth for the long term, like retirement, without needing to watch the market. Think of it as a no-mind portion of your portfolio. You're not trying to beat the market, you're not trying to find the perfect stock or respond to headlines. With the middle, your job is simple: just invest regularly and leave it alone. The market, time, and compounding do the rest. And it's flexible too. If your life changes and your income needs rise, you can reallocate funds from the middle to the base to increase your dividend income. It's your overflow tank, your retirement reservoir, and your mental bandwidth protector, all in one. In short, the middle exists so your money can keep working even when your main focus and attention is elsewhere. And that's the real power of no-mind investing. In order to truly hit that no-mind status, you need a reliable ETF. If you're completely new to this, don't worry. An ETF, or exchange-traded fund, it's just a basket of investments, usually stocks, that you can buy or sell like a single share on a stock exchange. Let's break it down without the financial jargon. ETF stands for Exchange Traded Fund. At its simplest, an ETF is like a basket of investments, usually made up of stocks, but sometimes bonds or other assets too. You buy the shares of this basket just like you'd buy a regular stock on a stock exchange. But here's the major point: instead of owning just one company, like buying a share of Tesla or Tesco, when you buy one share of an ETF, you're getting tiny pieces of hundreds or maybe even thousands of companies, all bundled into that one fund. That gives you an instant form of diversification. If one company in the ETF does poorly, the others can help balance it out. This is a big part of why ETFs are so popular with long-term, hands-off investors, and they're built to spread risk while still capturing growth. Now, most ETFs don't try to beat the market, they simply track it. For example, an S&P 500 ETF holds shares in the 500 biggest companies in the US. A global ETF might hold companies from dozens of countries, including both developed economies like US, UK, or Japan, and emerging ones like India or Brazil. There are ETFs for specific sectors like tech or energy, regions like Europe or Asia, or even strategies, dividends, ESG, etc. In my case, for the middle of the Metronome portfolio, I specifically choose an accumulating global ETF. Why? Because it automatically reinvests dividends back into the fund, so there's nothing for me to do. It covers developed and emerging markets, so I'm not betting on one country or one region to do well. And it's passive, so its fees are low. And it works completely in the background while I focus on the other parts of the metronome and let compounding do the work. ETFs are traded on regular stock exchanges, which means they're what's known as liquid, you can buy or sell easily, transparent, so you can see exactly what's in them, and easy to access through platforms like Trading 212 or others. So to sum up, ETFs let you own a lot of the market with very little effort. They're simple, efficient, and ideal for the long-term no-mind strategy I use for the boring middle of my portfolio. Here are the criteria I think are important for choosing such an ETF. Needs to have global diversification, developed and emerging markets, a low total expense ratio, what's commonly known as TER, accumulating dividend policy, physical replication, not synthetic, large fund size and high liquidity, tax efficiency where possible, and trades in GBP to avoid FX transaction fees. Meeting all these criteria results in a globally diversified, low-maintenance investment vehicle designed for long-term growth. It compounds returns in the background, requiring no active management or rebalancing, while offering broad market exposure and simplicity. It's ideal for investors who want peace of mind and steady progress without constant oversight. For me, the ETF or fund that I choose for this, that I believe satisfactorily fits the criteria, is the Invesco FTSE All World UCITS ETF, accumulating version with the ticker symbol FWRG. And for convenience, as that name is a bit of a mouthful and might be difficult to search, and I know there'll be questions about it, I made a pie with this fund inside it as the only component. That means you can find it much easier on Trading 212 if you're following my public profile on there. You don't need to copy it or even hold it in a pie really, I just made it so it's easier for you to find. As it's an accumulating ETF, there is not even the benefit of having dividends reinvested within the pie, so copying it is fairly redundant, but welcome to if you prefer for whatever reason. I can link to the pie with the ETF directly in the pinned comment down below so it's harder to miss. And speaking of Trading 212, if you're planning to switch to Trading 212, considering signing up as a new user, or even if you've signed up within the last 10 days, check the video description for the up-to-date promo code free fractional shares sign-up offer. Usually I'd mention the code in the video itself, but the offers are subject to change and it's much easier to edit details in the description of a YouTube video than to edit the video itself later on down the line if it changes, of course. I would also like to say that I will explain why I chose this ETF in the rest of the video, but I do want to make the point that it's not a recommendation or advice for you personally. You might agree with my thoughts, or you might want to alter them slightly once you see my reasoning. Let's take a look. First, geographical coverage, why it matters. Diversification is a fundamental principle of investing, helping to reduce risk by spreading exposure across different regions. A true global ETF should cover both developed and emerging markets to capture broad economic growth while mitigating localized downturns. Let's take a look at a comparison of global indexes. The MSCI World has developed markets, it doesn't have emerging markets, and has 23 countries in total. The MSCI ACWI has developed markets and emerging markets and has 49 countries in total. And the FTSE All World has both developed and emerging markets and has 48 countries in total. So the FTSE All World Index, in this case tracked by FWRG, includes a wide range of large and mid-cap stocks from approximately 50 countries. This means investors gain exposure to high-growth markets like China, India and Brazil, which might be excluded in other ETFs focusing solely on developed economies. Emerging markets often experience higher growth rates than developed ones, and by investing in FWRG, you tap into future growth drivers, ensuring your retirement investments benefit from a global economic expansion. A balanced approach is best. Now you might be thinking, if emerging markets are high growth, why bother with the rest of the global fund? Rather than going all in on emerging markets, I believe that a global ETF like FWRG offers the best of both worlds, excuse the pun. It has exposure to emerging markets growth, like India, China, Brazil. It has stability from developed markets like US, Europe and Japan, and lower volatility and better risk-adjusted returns over time. Going all in on emerging markets might seem appealing due to their historically higher growth rates, but I think a balanced global approach is more sensible for long-term investing. Emerging markets tend to be more volatile, prone to political instability, currency fluctuations, and weaker financial oversight. During downturns, they often fall harder and take longer to recover. For instance, the MSCI Emerging Markets Index dropped over 50% in the 2008 financial crisis, compared to a 40% decline in the MSCI World Index. And some countries like Brazil and Russia took more than a decade to recover. Another problem with going all in on emerging markets is they often face challenges like higher inflation, liquidity constraints, and restricted capital movement in some regions. Developed economies like the US and Europe still lead in innovation, corporate governance, and economic stability. The S&P 500 alone accounts for about 40% of global equity markets, reinforcing its influence. So by investing in a balanced global ETF, investors can capture emerging market growth while minimizing excessive risks, aiming for long-term stability. Then the next point is the total expense ratio, or TER. What is TER? TER represents the annual percentage cost of managing the ETF. It includes administrative fees, management costs, and operational expenses, reducing your net returns over time. If we look at an ETF cost comparison, we have the Vanguard FTSE All World, which is at 0.22%, the iShares MSCI ACWI ETF, which is at 0.2%, and then the Invesco FTSE All World, the FWRG, which is at 0.15%. With a TER of 0.15%, FWRG is one of the more affordable global ETFs, although the ETF with the ticker symbol ACWI offers an even lower TER of 0.12%. It actually lowered its fees after I'd already chosen FWRG, and I decided to stick with FWRG rather than hopping between any fund that decides to lower its fees at any given time. However, FWRG still remains a strong contender due to its accumulating structure and broad market exposure, making it a cost-effective choice for long-term investors. Up to you if you think that's a reasonable justification, or you think I'm just being lazy here and not switching to the lowest fees. The compounding effect of low fees. Assuming a £50,000 investment over 20 years with an 8% annual return, here's how TER impacts final portfolio value. So a TER of 0.15% has a final portfolio value of £233,047. A TER of 0.22% has a final portfolio value of £227,918. And a TER of 0.3 has a final portfolio value of £222,580. So assuming all else remains equal, lower costs increase your retirement savings, making FWRG a solid option here. The next criteria is dividend policy, accumulating versus distributing. ETFs can either distribute the dividends, so pay out the cash to investors, and these will have DIST or DIST at the end of the name, or they can accumulate the dividends, so reinvest them within the fund, and these will have ACC or AC at the end of the name. Invesco FTSE All World UCITS ETF ACC, or FWRG, the fund we are talking about, has AC in the name, so FWRG is an accumulating ETF, meaning dividends are automatically reinvested. This increases the share price and maximizes long-term growth. Why accumulation works best for what I need here. There's no manual reinvestment required, so it's more aligned with the no-mind approach I mentioned earlier. Dividends compound over time by themselves. More efficient for tax-free accounts like SIPs, etc., which incidentally is where I'm holding it for the most part. And if you're holding outside a tax advantage account, then it's a bit more complicated, but I can't talk about that kind of tax details without a ton of different disclaimers, so we'll save that for another video. Then we have the replication method, physical versus synthetic. This one is a little bit abstract, but still worth mentioning. If you zone out of this short section, I can completely understand. There are two ways that ETFs replicate an index. They have physical replication, the ETF directly holds the underlying stocks, and synthetic replication. In this case, the ETF uses derivatives to mimic the index performance. FWRG follows a sampling-based physical replication method, meaning it holds a representative selection of the stocks rather than every single company in the FTSE All World Index. So what does that mean? Physical ETFs have greater transparency and lower counterparty risk, whereas synthetic ETFs carry risks related to the derivative contracts. For what I'm looking for, physical replication is generally preferable due to its reliability and lower risk profile. There's no need to increase obscure risk for relatively little benefit here. Then the fifth criteria is fund size and liquidity. A larger fund typically has lower bid-offer spreads, greater liquidity, so easier to buy and sell shares, higher investor confidence. FWRG has an AUM of approximately £764 million, which provides reasonable liquidity and stability, although larger ETFs may offer even narrower bid-offer spreads. I think the largest is likely to be VWRL by Vanguard, but to be honest, I think this would ultimately be a probably pretty negligible difference, though happy to be corrected in the comments if you have evidence to the contrary. And then the sixth criteria is the domicile and tax efficiency. Here's why the domicile matters. The country where an ETF is domiciled affects taxation, particularly withholding tax on dividends from US stocks. A tax-efficient domicile ensures that the investors retain more of their returns. If we compare Ireland versus Luxembourg for ETF domicile, Ireland domiciled ETFs benefit from a 15% US withholding rate tax due to the US-Ireland tax treaty. This ultimately means investors keep a larger portion of the dividends from US stocks. Luxembourg domiciled ETFs, however, are typically subject to a 30% US withholding tax, as Luxembourg lacks a favourable tax treaty with the US. Some Luxembourg ETFs use more complicated tax-efficient structures, but Ireland remains the preferred domicile for tax efficiency. And why this matters for FWRG. FWRG is domiciled in Ireland, meaning it benefits from the lower 15% US withholding tax, making it more tax efficient for holding US stocks within a global portfolio. Over time, these tax savings can significantly improve net returns, especially for long-term investors. The seventh criteria is currency exposure. FWRG trades in Great British Pounds or GBP, eliminating foreign exchange or FX fees when buying through UK platforms. That being said, underlying assets are priced in the multiple currencies, so currency fluctuations will still affect the performance. Even though you buy and sell the ETF in GBP, its underlying holdings are in various global currencies such as USD, Euros or Japanese yen, and this means that if the pound strengthens against these currencies, the value of the foreign holdings decreases when converted back to GBP, reducing the ETF's performance. Similarly, if the pound weakens, the value of the foreign holdings increase, boosting returns. So you should be aware that while trading GBP avoids direct FX transaction costs on the platform, currency movements still play a role in long-term returns. So in conclusion, why FWRG is the best ETF for me. With global broad exposure, low costs, tax efficiency and a structure optimized for long-term growth, FWRG is my top choice for an ETF. While other ETFs may have slightly lower fees, FWRG offers an excellent balance of cost, diversification and efficiency, making an ideal investment for long-term retirement savings. Going straight to the lowest costs, or TR, as a strict rule, means that you'll be always having to keep up to date with the current fee structures, which takes away from the intention of it being no mind, at least in my opinion. I'm happy with FWRG as the choice for the middle of the metronome section of my portfolio, and I don't feel the need to change it. But there is one more inevitable question I will no doubt get that I should address. Why I choose global over just the S&P 500. If you've spent any time on finance forums, you've probably seen the go-to advice, just invest in the S&P 500, bro. It's repeated so often that it's basically a meme at this point. People treat it like gospel even when they don't fully understand what it is or what it exposes them to. And to be fair, it's not terrible advice. It's simple, accessible, historically strong and backed by some of the biggest, most powerful companies in the world. But that simplicity hides a few things. The S&P 500 is still just a list of 500 large US companies, that's it. It doesn't include the smaller cap stocks. It doesn't include emerging markets, and it doesn't include the other 95% of the world's population or economic activity. And while those companies are global in revenue, you're still investing only in one country's stock market, one currency and one political system. And that might be fine when the US is booming, but what if that changes? Recency bias makes the S&P 500 look like the only smart option. But if you zoom out a few decades, there have been plenty of periods where international stocks outperformed US ones. If you'd been investing in 2013 and look back 10 years, the US stocks were underperforming international markets more often than not. A global fund, like an all-world ETF, spreads your bets across developed and emerging economies, thousands of companies, multiple currencies, and a wider range of sectors. It captures growth wherever it happens. And while the S&P 500 might do better during bull markets, a global fund offers better balance during downturns. It's not about performance alone, it's about resilience. So why do I go global? Because I don't want to guess which country wins next, really. I want to own the whole race. Final thoughts. At the end of the day, the middle of the metronome isn't supposed to be flashy. It's not where the excitement happens. It's where the compounding, the consistency, and the hands-off wealth building takes place, without needing your constant attention or emotional energy. By choosing a globally diversified low-cost accumulating ETF like FWRG, I've created a part of my portfolio that keeps ticking in the background, no matter what's going on in the markets or in my own life. It's not about picking the perfect stock or reacting to headlines or stock tips. It's about staying invested, staying calm, and giving your strategy the time it needs to work. The boring middle might not get much hype online, but it's where most of the real progress happens. So if you're building a portfolio for the long haul, one that supports your freedom, your peace of mind, and your future, the boring middle is exactly where you want to be. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!